Net takeaway was more positive than when you came into this week, or negative?
No, I think it was certainly more positive. I think there's been a lot of investor angst around credit quality. And after banks built really big loan loss reserves in the first half of the year, it feels like they're almost done with that process. And loan losses, which have really been non-existent to date, feel like they're going to remain benign at least for the third quarter and potentially into the fourth. And then on top of that, fee income trends also appear better than expected. Mortgage results have been very strong. Trading and investment banking fees appear to be tracking ahead of expectations. And you're starting to see rebounds in other consumer-related fee products as well. And then, additionally, banks continue to kind of manage their costs is what a challenging net interest environment. So I'd say one of the negatives is clearly low interest rates are having an adverse impact on net interest margins, and banks are finding, the fee income side to help compensate for that.
I guess when we look at the share prices year to date, Jason, clearly they've underperformed massively. One factor people point to is the lack of buybacks, which had been so significant for the sector in recent years. Any update on when they might be able to return? And do you think they're crucial as a catalyst to give this sector a boost that it's clearly been lacking for so long?
Yeah, I think executives are trying to figure that out. Clearly, they're not allowed to buy back stock in Q3. I think around the fourth quarter, it's still uncertain. But the point we make there is, even if they don't buy back stock in the fourth quarter, they certainly should be able to envision to buy back stock next year. So it's not like that capital disappears. They're going to accumulate a lot of capital in the third quarter, and if not buying back stock, actually accumulate more stock in the fourth quarter. So shareholders will ultimately be getting that back returned to them either in the form of higher dividends or share repurchase. So it's just a matter of waiting, an extra quarter or two. So it shouldn't be the end of the world.
It's been interesting to watch the banks underperform on good days and underperform on bad days alike, Jason. Are banks trading off fundamentals? How do you explain the fact that even relative to more cyclical groups like industrials and materials, they seem to be underperforming on a better economic outlook?
Yeah, they certainly are unloved. And in fact, if the year ended today, this would mark the worst year in relative bank stock performance in history. And we have data back 84 years. So clearly, they're unloved. And I think early in the year, I kind of got it where people were trying to figure out what the ultimate impact of this pandemic was with respect to loan losses. I think now that we're 6 months through, and you should have a better understanding, or at least the banks have a better understanding of what their loan portfolios look like, and they've scrubbed them. In addition to kind of entering this period, record capital and record liquidity, we think going forward, kind of further good news should be better received.
Jason, does the news flow this week explain why Citi's down 11.3% in what, 4 trading days?
Yeah, I think, with respect to Citi, they were, I would say, less constructive on their outlook for trading and investment banking than JP Morgan. They also talked about some expense pressures. They're going to spend an extra $1 billion this year on risk and controls. And I think investors took exception to that. And then on top of that, there was some headlines they could be facing a potential consent order from the OCC tied to their recent issues around Revlon. That's giving investors some pause in the near term as they try to flush that out.
So which is your favorite?
Yeah, no, I think that we still have a bias towards the bigger names. We think, in the current environment, the bigger banks had the benefits of leveraging technology, increasing market share, adding customers, and the ability to kind of just benefit from scale. So, JP Morgan and Bank of America, we think both showed particularly well at the event this week.
Jason Goldberg, thanks for joining us.
Thank you.